highlighting that. It's Ian Taylor here. I'm the Vice President of the CFA Society Ottawa this year. And so thank you again for joining us for another webinar from our webinar series. Obviously, we launched the series early last summer once it became clear that we weren't going to really have the opportunity as a society to network over this pursuant months, and obviously we're still in that situation today. But nonetheless, we have been able to bring you some pretty interesting topics and speakers throughout the year, and really happy with the engagement we've got on that. And again, today we've got another really good speaker and very timely speaker to really enlighten us on the economy today. But before we get there, I just want to remind everyone of the upcoming CFA Society Ottawa Forecast Dinner. It's the virtual event this year. Hopefully next year's event will be live, but it's really, the event last year we postponed, and we planned to have Prime Minister Stephen Harper, former Prime Minister Stephen Harper, and CFA Institute President Mark Franklin. So they will be attending and speaking, and a bit of a panel format at the beginning, and certainly a lot of interaction there. So they'll be the keynotes for this year. So I really encourage you to sign up. So it's April 21st. But really, one of the neat features of this year, we're working with Becta. So many of you will know that, one of the premier restaurants in Ottawa, and their sommelier. So Connor Gallagher, who I'm led to believe is quite good. You'll be getting, if you sign up before March 31st and you choose the option to have the Becta option, there's great value there. But you will have wine and charcuterie if you're in the Ottawa area delivered to you. We have some options if you're outside of the Ottawa area. But you'll be able to follow along with a wine tasting throughout the event. And as I joked the last time, my wife generally is not too interested in coming to these events with me when they're live, but she's pretty excited about the fact that we're going to do some wine tasting here at home. So maybe a good opportunity for you, those of you at home, to enjoy just a little bit of a different experience this year. So with that, I mentioned it's a timely time to host our speaker coming up here. We've got the Federal Reserve should be releasing their minutes at 2 o'clock, and then their statement at 2 o'clock today. But with us, we do have Jean-François Perrault. He's the Senior Vice President and Chief Economist of Scotiabank. So he joined Scotiabank in 2015, and there he leads a team of economists to support Scotiabank's domestic and international business lines and clients, from retail to capital markets, providing Scotiabank senior executives, business lines, and customers with perspectives, insights, and forecasts on economic, financial, market, and policy developments. And obviously, we get to share in that today, which is great. So prior to joining Scotiabank, Jean-François held prominent roles with the federal government, the Bank of Canada, the International Monetary Fund, and the World Bank. So without any further delay here, we'll get right in. So welcome, Jean-François Perrault.
Thanks, Ian. So I'm going to share my screen, and hopefully I can transition this in a way that works. And here we go. Does that work? Can you see that okay?
Yes, we see it. Thank you.
Super, great. So thanks for dialing in, tuning in, whatever we call that these days. So I've got a deck which I will go through. But really, I guess the title of the session was, too hot, too cold, or just right. I'm gonna answer that right away in the following way, which is to say that right now we are too cold. We'll eventually be to just right, and we're likely to be too hot at some point in time. Then I'll kind of walk you through why it is that we are leaning in kind of that characterization of the outlook. So, properly. So let me just kind of give you straight to the bottom line. We are anticipating quite strong growth in Canada, in the US, and elsewhere in the world this year. You can see from the table on the right here that we're anticipating 5.8 for the world, 6.3 for the US, 6.2 for Canada. So almost the same thing as the US. And equally importantly, we're anticipating pretty strong growth going into 2022 as well. So kind of a 1-2 punch for both years, which is pretty exceptional. I mean, we're looking at, for both the US and Canada, record strength this year. then there's kind of this 1-2 punch of almost more than 10% accumulated over 2 years. Obviously, the record as well. So I'll unpack a little bit why it is that we think that is likely to happen, and hopefully we'll be able to convince you, and obviously walk through what that means for interest rates and central bank policy, and including perhaps what we might hear from the Fed later on today. So the point of departure really is, so there's a number of ways you can put a forecast together in my business. You can, you can use kind of your finger and kind of gauge the wind. You can use your judgment, experience. You can follow the data very closely. We do obviously a little bit of everything, but if we were to just kind of step aside from COVID for a moment and look at what are traditionally fundamental drivers of economic activity, particularly in a Canadian context, like things that we would normally point you to say, okay, well, this is happening. This is an indication that growth is going to pick up over the next little while. So there's a number of these things that we look to, and I'll go through some of them just to give you a sense of how powerful the growth signals are, even before we start talking about kind of COVID recovery and that kind of stuff. And the starting point for a lot of this is what's happening, obviously, outside of Canada. So if we go back a few months, go back to say the pre-election period in the U.S., we had a few surprises that pretty fundamentally changed the perception of what is going to happen, what would happen over the next 18 to 24 months. Obviously, in the lead up to the election, you had then candidate Biden, now President Biden, articulate an economic vision for the U.S. that relied heavily on stimulus. So a pretty clear economic plan on his part. Given the fact that the polls were leaning in his favor, that was kind of translated into financial market space to some extent. So some optimism being built into financial markets in the second part of last year, anticipating stronger U.S. growth, largely because of the Biden fiscal plan. At the same time, you had the development of the vaccines, which occurred, I think it's fair to say, a fair amount sooner than people anticipated. And of course, once the vaccine is in play, you can downplay some of the tail risks to the outlook pretty significantly, because that unless the virus mutates significantly, we knew that at some point in 2021 we would start looking at the virus in kind of the rearview mirror. So those two factors, combined with central banks saying they're going to keep interest rates low for an extremely long period of time, really kind of provided a pretty powerful global backdrop for developments in a few sectors that really matter for us. So the first is obviously the chart on the top left here, and I'm sure you've all heard a lot about this, is the significant increase in commodity prices. So this is a reflection partly of anticipated strength. This is particularly true in the oil side. So anticipated strength in the global recovery. Also a function of supply-demand imbalances in things like lumber and copper and other things, where economic activity is recovered a little bit more rapidly, possibly a lot more rapidly, depending on perspective, than anticipated, and you simply had producers not ready to accommodate that increase in demand. So you've had very significant increases in a number, like a broad range of commodity prices, whether it's agriculture, whether it's kind of building related or industrial related, or obviously oil. And that, we are still a country that is heavily dependent on commodity prices. So, we think of this as a wealth shock, right? Higher commodity prices for Canada means that the country is wealthier. There's no other way around that. So the increase that we've seen, which is substantially stronger than what we'd anticipated a few months ago, of course, substantially stronger than what that others anticipated a few months ago, that provides a pretty significant kick to economic activity this year and next. Obviously, there's a question of how sustainable that is, but even if they come off recent highs, and they don't seem to want to come off recent highs, our forecast is based on commodity prices that are probably about 10% lower than where they are now. So there's a cushion there. The second and kind of associated aspect is obviously the evolution of equity markets, which have rebounded very, very significantly throughout the second part of last year for partly reasons that I've indicated earlier. And that seems to have some legs and strength to it. I think from our perspective, U.S. growth prospects are probably still a little bit underappreciated in some markets, and that suggests to us that there might be still some upside risk to equity markets. But the upside of these developments is, as equity markets pick up, obviously there's an indicator value there. It reduces the cost of capital to firms that use equity markets to finance activities. But equally, if not more importantly, equity markets or equity wealth is another driver of wealth in Canada, right? So when equity markets go up, we spend more, plain and simple. It's a more powerful effect in the US than it is here, but it still applies here. So you can see from the chart, obviously, the very significant increase is another indication that we are going to be benefiting from, another type of wealth effect. You combine that with interest rates that are still extremely low. I'll talk about that in a little bit more detail later on. But you're, experiencing this environment where commodity prices are really strong, equity markets are really strong, the growth outlook is pretty strong. Interest rates are, even though they've come up, as you can see from the chart, still remain extremely low by historical standards, particularly when compared to the growth outlook. Another factor which we actually believe is a bit of a headwind to growth now, when there's a debate on this, is the Canadian dollar. The Canadian dollar is, and I have a chart at the end of the deck to explain this a little bit, but our sense is the Canadian dollar is undervalued still. It's moved up a lot, but when we kind of break it down by fundamentals, and we've got a couple of ways of looking at that, we think the Canadian dollar should be trading around 81 cents right now. That would be kind of a neutral value for the Canadian dollar. It's not there. So we call that kind of a fundamental disequilibrium, and that disequilibrium means the Canadian dollar is undervalued, and we are benefiting from that to some extent. Not hugely, but it is not a drag on growth. We think it's positive for growth. And of course, there are other things going on as well on the household side in particular, which really suggest that the year is off to a very powerful start. So I've given you a couple of indicators of that already on the equity market side and to some extent on the commodity side, but there's other stuff going on. There's been this fantastically unexpected evolution over the last year where Canadian household balance sheets have by and large improved very significantly. So coming into 2021, Canadian households are in a very good position to increase consumption as the year progresses. In fact, probably for the next couple of years. And you can look at it a number of different ways. The way that people kind of think about it most these days is this chart on the top left, which is basically how much cash are in bank accounts. And as you can see from that chart, so this is the year-over-year change in deposits for both individuals and corporations in the Canadian banking system. You're looking at, in Canada, household deposits up about 150 billion year over year, right? So that's money that's in bank accounts now that wasn't in bank accounts. So this is as of December, that wasn't in bank accounts in December 2019. We know that's going to get drawn down. We don't quite know why, so we don't quite know on what. Is it going to be to pay down debt? Is it going to be to invest? Is it going to be to buy stuff? Certainly the evidence that we have so far suggests that there is a significant amount of pent-up demand for a range of goods, which we think are going to be partly financed by these deposits, right? So as we reopen, things we're once again allowed to buy certain types of things that we haven't really been able to buy over the last number of months. We anticipate some of those deposits are going to get drawn down a little bit. But it is very unusual to kind of end a recession, if you want to call this a recession. It's more of an economic shock, with households in such good financial position, in particular with them having access to so much cash to finance expenditures for the next few quarters. The other aspect of it is, with the chart right underneath that, obviously the housing market's done extremely well, and I'll explain why that is in a few charts in a few moments. But the upside of that has been that we have seen a very significant increase in residential wealth. So the value of homes has been rising more rapidly, significantly more rapidly than the amount of mortgages that are underlying that. So as a result of that, the owner's equity in real estate is rising to roughly 74%, just a little bit more than that, which is significantly higher than it was in second half of 2018 through the middle of the pandemic. And that's a particularly important thing to watch, because we know that in Canada in particular, households spend out of housing wealth much more so than you do out of equity market wealth, right? So they'll they may borrow against that, they may draw down some credit, they may they may use part of their wealth to buy a car, or renovate their place, whatever. There's a range of things that happens, but there is pretty compelling evidence that housing market wealth in particular supports consumption. Now, you could argue, well, that may be true, but as I kind of alluded to, I mean, debt has been rising, certainly mortgage debt. But if you look at the chart on the top right, you get a bit of a perspective on, how solid are household balance sheets, and this is a really good way to think about it. So this is the household debt to asset ratio, which in the most recent observation, which was the end of, so the fourth quarter of 2020, is at a record low. So, that it speaks for itself, right? From that perspective, households have never had this advantageous financial position. And the same is true with household net worth, so which is kind of the whole kit and caboodle. So assets minus liabilities of households as a proportion of income. That's basically got back to historical highs in the last quarter. So very, very solid, performance on the part of households. The bottom right chart is, something that some of you may have seen. It's just to highlight how unusual this all is, because we obviously had a very significant increase in unemployment rates last year. We had a very significant economic contraction. Disposable income, exclusively because of government transfers, rose at its highest rate in history. So you had this inverse relations, right? People were losing their jobs, and Canadians were earning more as a result of that. Obviously, not something that happens it's not something that usually happens, and it's exceptional, but it speaks to some extent, why we are in the position that we are on the household side, which is going into 2021 with a very solid base from which to launch the expansion. Now, of course, we are coming out of a very difficult period, and it remains a very difficult period for a number of groups. There's no question about it. So unemployment rates are still high for both males and females. There's obviously a gender dimension to this, particularly for families with children, where female participation in the workforce is dragged down relative to males. But you can see from these various charts, you've heard of kind of the K-shaped recovery, which is that some sectors of the economy have done very, very well, and that's true. A number of sectors have done quite well. Others, particularly those that are more dependent on mobility restrictions and the evolution of the virus, have done significantly differently. So you can see that, for instance, in the top right chart. You can see that in some cities which kind of are more dependent on tourism or those kinds of things, which is the bottom chart. That's just the reality that we're in, that we are effectively kind of a two-speed economy, and will remain a two-speed economy until the virus is well behind us and we reopen things. But for those industries that are somewhat distant from the virus, if you will, so they're not frontline on the virus side, what we are seeing is really quite exceptional strength by and large. In fact, as I was talking to some clients of ours earlier this week, and I'd had previous conversations with other clients in the weeks before that, who are not kind of frontline COVID industries, who are complaining now of the same thing they were complaining almost a year ago, or a little bit more than a year ago. So pre-pandemic, which is they're running out of workers. It's difficult. Their main challenge is talent. which is not really something we heard over, the middle of the summer and through the fall, but it's something that's happening again. So very, very different dynamic, very different conversations that are being had around certain boardrooms in relation to the anticipated strength of the economy, but also in relation to the previous strength of the economy. And I'm just going to go back quickly to this chart to explain why that is. So if you look at Q4 and Q1, so Q4 2020 and Q1 2021, so obviously Q4 is now known. It's 9.6%, so almost 10%. Q1 remains a forecast. If we were to go back in history and look at the forecast we had for Q4, say in September or October, when the second wave was starting to hit us and restrictions are starting to be put on, we had significantly slower growth than 10%. I think our first cut was about 2% or so. And that got revised pretty quickly because the numbers were coming in stronger and stronger and stronger. And in Q1, which is, January is like the peak of the restrictions, right? You had red zones all over the place in various provinces. You had, curfews in Quebec in some cities. So like the, peak level of mobility restrictions, we were anticipating a decline in economic activity. We thought these lockdowns were going to have a negative economic impact. And now, as I said, growth came in about 10% in Q4. We're tracking our official forecast for Q1 is 4.5% growth. The tracking, based on most recent data, suggests it could be up to 6.5. And the reason I want to point that out to you is that even though there are these industries that are suffering, the economic momentum in the rest of the country is really quite substantial. So even in the presence of lockdown measures, even in the presence of, COVID-related frictions and worries, you're managing to grow 10% one quarter, and you're going to grow, 4, 5, 6% in the quarter where you've got peak restrictions. And that economic dynamism, married with all the other stuff I talked about in terms of, fundamental drivers of growth, really sets you up for, as I said, growth over 6% in Canada, obviously a larger amount in the US because they've got this massive stimulus that's about to hit them as well. And it's a remarkable period. So before I kind of go back into some of the details, let me talk about one of the things that is pretty important to the forecast for a couple of reasons, and that's the housing market. Now, I've talked about how housing market wealth has increased, and that's a good thing, and it's supporting growth. Obviously, if you think house prices are going to crash, then that housing market wealth is kind of temporary. Our sense is, and we've believed this since pre-pandemic, actually. Ian will attest that I was talking about this when we last did a chat together, I think in Vancouver, February last year. The Canadian housing market is fundamentally undersupplied. It's a chronic problem. And you can see that in the bottom chart here. So, this chart says not enough supply. What that presents is basically the number of new housing units that are built in a rolling 36-month period versus the increase in population over that period of time, right? And basically, when that line is falling, it means that the number of housing units relative to population is falling. You're not keeping up. It's come up a little bit recently because population growth has slowed because there's been low immigration, but you can see pretty clearly, since 2017, that we are, relative to history, significantly undersupplied in terms of new housing construction relative to population growth. So it's a pretty kind of fundamental way of thinking about it, right? So we know there are not enough homes in Canada relative to the amount of people that there are in the country. And this was true pre-pandemic. What's happened in the pandemic, obviously, is there's been a change in attitudes and working from home and people wanting bigger places because they're stuck at home or wanting studies or backyards or all this kinds of stuff. So it's led to pretty significant movements in real estate markets across the country of course, facilitated by the cut in interest rates engineered by central banks and the decline in yields associated with that. So you've seen, in addition to this chronic undersupply of housing, you've seen sales pick up and inventories or listings, collapse or not keep up. So you end up with situations like the chart on the top right here, which is the sales to listing ratio in Canada, which in January hit a record level of over 90%. It's come back down a little bit in February as there was an increase in listings, not a huge increase in listings, but there was an increase in listings. So that ratio came down a little bit, but you can see from that chart just how out of whack sales are relative to what's available to buy. And we know, combining that with the bottom chart, that that's a kind of a structural feature as well. So if you will, kind of the float in the market, so the inventory, the listings is very low, and the supply is also extremely low. So as a result of that, you have a pricing environment that's squarely in favor of sellers, and this is more or less across the country. And it doesn't look like it doesn't look like that's gonna reverse anytime soon. We are facing a chronic undersupply. So we think the housing market's got quite a bit of legs to go. We think sales are going to remain strong. In fact, the break on sales might be simply that there aren't enough homes to buy, and that slows sales down, but obviously means that prices remain very elevated. But I talk about this because, coming back to the fundamental drivers of growth aspect, it does suggest that the strength in house prices and the increase in wealth that we've seen is sustainable. In fact, might actually increase as we go forward. So that's an important thing to keep in mind. Adding to these kind of backward-looking measures of housing market resilience, if you will, we have gone through a year, and you can see on the chart on the right here where immigration has collapsed. Obviously, our borders are closed, so significant slowing down population growth. That's likely to be temporary. We already know that, we know the federal government's committed to increasing immigration levels quite substantially. There's already been a significant pickup in immigration already this year. So we're on track to meet some of these objectives. But of course, as that happens, as you start raising population growth again, this chart, this line on the bottom here, this in the middle bottom chart, is likely to start going back down again. So again, a challenging situation for housing markets. If you're on the buying side, if you're on the selling side, fantastic. So when you put it all together and kind of look at, what parts of the economy are going to be growing, how quickly we return to where we used to be, this is an interesting chart on the left here. So these are kind of various vintages of forecasts in terms of how quickly would we recover lost ground of the pandemic. And you can tell, and we're not really any different than anybody else here. Everybody's kind of everybody that would do a chart like this would have a similar kind of dynamic to their forecasts, including the Bank of Canada. You can see how much more quickly things are rebounding than we'd anticipated in various vintages of the forecast. And I'll just point to you again to Q4 of last year and Q1 of this year, which you're still going through. We went through a pretty vicious second wave with pretty serious restrictions. We thought that was going to bite, and for whatever reason, it didn't. So revising our forecast as we're going through a second wave. So, we're now at a point where we think we're going to recover the lost output to the pandemic, in between 4 and 6 months from now. 6 months ago, we would have said that was like a late 2021 event. So we're, 2 quarters, 3 quarters ahead of where we plan to be. Not plan, but where we forecast. And that's important to consider as we get to the monetary policy part, because it just speaks to the speed at which forecasts are being revised, the challenges posed to central banks, which are substantial. But before we get to that, if we just look at the chart on the right, just to give you a sense of which components of GDP consumption is going to be a big driver this year and next. I think I've given you indications as to why that is. there's a lot of pent-up demand, and we know that financially consumers can meet that. So it's just a matter of people being able to buy what it is that they want to buy. The other big driver of growth is residential investment. I mean, the market's off to record, like January and February are already all-time highs. We know the year is off to a fantastic start. That's probably going to get even stronger as we go through the spring, and there's more inventory and you get more volume. So that's a pretty powerful start to the year on the residential side. So we expect that to contribute positively to growth, obviously. Government spending clearly is an issue. As you know, the federal government is going to come out with a Building It Back Better plan, if they're still calling it that, sometime in the spring, not this month, maybe next, maybe in the month of May, we'll see. They've already committed to doing 70 to 100 billion. I wouldn't be surprised if they do a lot more than that over a 3-year period of time. We're not quite sure what gets done, but obviously that is an element that's going to contribute to the strength that we observe. You will notice that the brown line, the brown bar, which is business investment, is expected to remain pretty low, and that's we've got equations obviously to help us come up with that, but it's it's a reflection that business investment in Canada is generally on the timid side of things, and given the uncertainty that still exists, even though some sectors are doing quite well, there still is a sense that we're in the middle of this pandemic. There's going to be a third wave. Not sure if the vaccine is going to take control for all the variants. So there is a little bit of hesitancy on the business side. So we're kind of building that into our forecast. But even as we put all this stuff together, which brings us to about 6.2 for Canada for this year, when we look at the individual components, so when we look at consumption and we try to figure out, okay, how balanced are the risks here? If we do the same thing on residential spending, if we do the same thing on government, we look at our forecast and we think, we don't feel particularly optimistic. Let me rephrase that. We're not sure we're optimistic enough in our view, that we think the risks are tilted to the upside. Now, what could happen is, you've got a greater inventory build, more of an inventory drawdown, that we import a lot more, and that kind of brings growth down. But if you just look at consumption and residential investment, the indications that we have so far this year are that, if anything, risks to that are to the upside. And that doesn't include another risk, which is which we can talk about in this chart, which is that the Americans are rolling out a massive amount of fiscal support. The 1.9 trillion plan, the American Rescue Plan, it's an unbelievable level of fiscal support. So our forecast for the US is 6.3 right now. That is on the basis that there is a reasonably low multiplier on that fiscal support. And multiplier in this context simply means, how much growth are you getting per dollar that you spend? So we're assuming something like 25%. If you assume something higher, in the 50% range or in the 40% range, you easily end up with 7 and above growth in the US. So as we think about our US forecast, we think that we're underplaying, that we're being cautious, that even at 6.3, the upside risks dominate the downside risk, which of course translates into the Canadian space, translates into the global space, translates potentially into markets as well. And you can see some of the challenges that poses on the chart on the right here, which are output gap estimates. In Canada, if our forecast is correct, we think the output gap kind of goes to about 1 3/4, late 2022, early 2023. That's going to allow the Bank of Canada to tighten. In the US, we see the output gap going to 2% more rapidly, and there's a potential for that to go even higher if our view of potential output is correct, which of course is unmeasurable, so we could very well be wrong on that. But when you start to think then about, say, the US in particular, because we also know that in the US, which is not in our forecast at all, President Biden is thinking about going with an infrastructure plan as well. Estimates vary, but between $2 and $4 trillion that he wants to roll out sometime later in the year for implementation whenever, 2022, 2023. We'll see what the details are, but that doesn't incorporate that. Right, so that's another 10-15% of GDP spread out over a period of time. So obviously, if that happens, then this blue dotted line, like we're going to have to increase significantly. Like the U.S. is going to have potentially a challenge of having too much economic activity, right? And possibly triggering a boom and bust scenario. That's not in our forecast yet, in part because we're waiting to see what happens with that aspect of the Biden plan. But as we kind of come out of COVID, that is one of the considerations that we have is, are we at risk of overstimulating? Are we going to pay for this at some point in time? Not in a fiscal sense, but in a dynamic sense, right? Are you going to boom and then bust? One of the things that folks would look at in that context is the performance of inflation. So we don't think inflation is a problem. We got inflation data this morning in Canada. It's the average of the Bank of Canada's 3 measures is 1.7%. So it's come down a little bit from 1.8, which was last month. Suggests that there's still some ways to go for inflation to be sustainably at 2, which is what the Bank of Canada wants to achieve, even though money supply growth has been very, very strong, which is obviously, you can see from the left-hand chart here. There have been times in the very distant past where there was a reasonably good correlation between the evolution of the money supply and inflation. We haven't been in that world for decades now. But if you look at just the size of the increase, it does raise questions as to whether or not, the growth that we're seeing in combination with the increase in the money supply, whether that might not indicate that inflation is going to come back a little bit more strongly than central banks think. We're not in that frame of mind. We're not in that camp. And we're not in the camp of thinking inflation is going to be 3 or 4% in the U.S. or Canada. But obviously, we're in the camp that inflation is going to rise in both countries. In the U.S., we think it kind of hits a peak of about 2.5% sometime in 2023. In Canada, a peak of about 2.3% by the end of 2022. I don't have charts for that here, but that's our forecast. So as a result of that, central banks are in this tricky situation of, it's clear that we currently need stimulus. There's no question about it, right? Inflation is still below 2. We're still, in squarely negative output gap territory. That's going to change as we go forward. We have anticipations that growth is going to be really strong. That could disappoint, but that's certainly the anticipation. And central banks are still, up until, we'll see what the Fed says today, we'll see what the Bank of Canada says in about a month. We're still in a world where, both the Fed and the central bank are saying we are not planning on raising rates until, in Canada's case, 2023, which is when they believe inflation will be sustainably at 2. In the U.S. case, 2024, if that. So of course, markets are interpreting all this. So they're looking at the rapid improvement in economic conditions, thinking there's going to be inflation associated with that. So you saw inflation pricing or inflation expectations in credit markets pick up to roughly where the targets are. So it's not really a worry on our part, but it's well higher than where it used to be early in the summer. With the message where central banks are saying what's happening isn't leading us to change our perspective on things. So you're getting a pickup in obviously a steepening of the yield curve. Totally understandable. I mean, we've been forecasting this for quite a while. It's happening perhaps a little bit more rapidly than we thought, but it's in line with the strengthening of the economic environment. The challenge for central banks is, they are going to have to recognize that the outlook is significantly better than what they most recently published, both in the Fed and the Bank of Canada's case. They have no choice but to revise their forecast upwards. I mean, that's the data just clearly indicate that. Their challenge is though that they don't want financial conditions to tighten very much, right? They are conscious that if they were to change the message that they send with respect to the strength of the outlook, the possible path for inflation, that there's going to be pressure on them to raise interest rates sooner rather than later, and they're not ready to do that. Our view is they're going to raise interest rates well before they both will say they want to now. So in Canada's case, middle 2022 or late 2022. In the Fed's case, middle of 23. About a year earlier than what the Fed would suggest. they're not ready, I think, to admit to that. So in the meantime, you've got this dynamic where markets are basically saying to the central banks, you need to think about raising rates. You need to signal that you're going to do something about this, because if you don't, inflation expectations might pick up more and will steepen the curve, which of course would be bad for growth. Versus central banks not wanting to act on that, with the implication that maybe if they don't act on it, if markets kind of take this a little bit too far, you actually would get a tightening in financial conditions absent a central bank tightening. So we might actually be in a world where it actually, as the summer progresses, financial conditions might actually be looser if central banks were to be seen to be a little bit more aggressive on the tightening side. So the possibility of the short end moving up a little bit more might keep inflation pressures down from a market perspective and prevent too much of a steepening of the curve. So that's kind of the challenge that central banks are faced with. It's not an easy situation for them, especially when we know on both sides of the border that there are parts of the economy which are still extremely damaged, right? There is no question that the K-shaped recovery is a fact. There's no question that industries are significantly affected still. There's no question that the unemployment rate is significantly higher in some industries than it was before. There's no question there still needs to be a lot of repair. That repair is occurring very, very fast, but it still is the case that we need some repair. And it's awkward for central bank to start with that context to start talking about the economy in a very positive way. So that's their challenge. I think I've just got, so this is my last chart. Just to give you a bit of perspective on the dollar, I talked about it a little bit already. This is our path for the dollar, but essentially when you look at a fair value for the Canadian dollar, and we don't use PPP, we just use PPP here just to kind of give a graphical view, but we use kind of a fundamentals based model, looked at interest rate differentials, commodity prices, growth differentials, and risk preferences, so risk on, risk off moves. All those suggest that the Canadian dollar is undervalued and that it's going to go up a couple cents, although it's been moving up pretty significantly the last 3-4 days. We think that's likely to continue for a period of time. So with that, I can maybe, and I apologize if there are any questions that haven't been, good, there haven't been anything in the chat. If there are any questions in relation to anything I've said, I'm happy to entertain those. Whether you want to hop on video or you just want to type something in the chat, that's up to you.
Look like thanks, Jean-François. It does look like we have one question, so we can walk through that now. So, you talked about the housing prices, and I know immigration was a big part of your theme last year and continues to be based on what you're talking about here now. But it's really talking about median family incomes in Canada. How much does that constrain the ability for housing prices to continue going up?
It doesn't.
The supply issue seems to be something you're pointing to, but go ahead.
I mean, the reality is that what might happen is that traditional measures of income might make it harder for Canadians to borrow in the regulated financial system, right? So there are limits on gross debt service, total debt service, and that kind of stuff when you get an insured mortgage or when you purchase through a regulated financial institution. What we've seen, and this was true pre-pandemic, particularly as a result of the B20 change, which made it harder for individuals to qualify for mortgages, you saw that shift to the unregulated part of the economy, part of the financial system. And that is something that's likely, I think, to continue as we go forward, because the reality is that as good an investment as it might be, you still have to be able, somebody needs to lend you the money to make that investment. And at some point, it could be that financial organizations like mine are having a hard time doing that just because of the regulations surrounding all that stuff. So that might be a little bit of a hiccup, but when you look at other countries, I mean, Canadian households in most cities aren't particularly indebted compared to households in the world's major cities, right? And Toronto and Vancouver are definitely world-class cities. So if you compare it to Paris, or you compare it to Tokyo, you compare it to London, You compare to some of the Australian cities, other European cities. We're not an outlier. If anything, we outlie on the low end of things as opposed to the high end of things. So I don't think it's a huge constraint.
We've got so thank you. We've got a few other questions here. So one on, well, you just talked about inflation and the prospects for inflation. Maybe some of that is tied into what are your perspective on gold, and then also on Bitcoin?
So whatever. I mean, Bitcoin's not, obviously it's an investment that paid off extremely well. But people approach it as I think the right way to approach Bitcoin is think of it as an investment rather than a sustainable means of payment between individuals that is going to take over the world in the next few months or quarters or years. It's just for something to have value on a transactional basis, like there needs to be some degree of stability, and like Bitcoin is just not that. It's a fantastically volatile financial instrument, and interest in it depends on a range of things, including momentum. But it's also, folks, to some extent, it's replacing a little bit what gold used to do, which is as you worry about inflation, or you worry about global risks, or you worry about your portfolio and you're looking for places to park your money, gold historically was one of those hedges. I think folks are starting to think about Bitcoin along that way, although it's so volatile that I don't know if you get a whole lot of comfort out of that. You certainly made a lot of money off of that, but I don't know if it serves that purpose very, very well. Gold is it's less, I mean, in our perspective, it's less of a hedge than it used to be. Obviously, it moves along with interest rates, of course. The traditional way, one of the traditional ways to think about gold is kind of this inflation hedge. And I think, as I said, I think Bitcoin's taking a little bit of that, but also I think that the inflation story is overblown. I don't think we're likely to have 3-4% inflation in Canada or the US. History has suggested that inflation, if anything, tends to disappoint on the downside, and it's much harder to boost inflation than it is to lower inflation, even though you've got clear signs of inflation in commodity prices. There's no question about that. There is a sense out there that inflation is mismeasured, and you hear a lot of folks talk about this. That who here believes that inflation is 1%? In Canada, it's 1.7. Like inflation is rising more than that in my world. And that, people can think like that and articulate those thoughts, but the reality with inflation, especially in Canada, is that it's an extremely well measured concept, right? It's survey based in the sense that StatsCan looks at what people are buying, and they ascribe certain weights to that, and they form a basket around that. They send people in stores of various kinds to figure out, monthly what those items are trading at. So it's a very, very scientific process. So the measure of inflation, as it's reported in Canada, is pretty accurate. So folks will argue, well, I'm looking at these measures of inflation that are 10%, looking at this survey or that survey, and that creates a bit of a fear around inflation. It creates a little bit of worry that central banks are going to let things run too hot for too long. But I think when you really kind of focus on the more scientific measurements of inflation, it's a much less worrisome perspective, and therefore I think from a gold perspective, it's also a bit of an overblown thing.
And just I guess, so moving away from sort of the asset classes and looking at the stock market specifically, are there just different sectors that you would anticipate benefiting? As your view on the economy plays out, what stocks would likely benefit at this point in the economic cycle?
Yeah. So, and some of this has already happened, but if you think about the global economy in like 21 in kind of the first versus second half dynamic, obviously the first half is still like those sectors and industries that did well last year are continuing to do well. Tech, manufacturing, basic, anything related to commodities and construction, and so that's a given. What we think is going to happen though is that when economies reopen, more completely next few months, probably end of summer. We'll see. There's questions of when that happens. You part of this pent-up demand that we've observed is going to rush out the door for things like travel services, for stuff that you haven't been able to buy, so restaurants and chains and all this kind of stuff. And those obviously have been the parts of the sectors that kind of have suffered the most and continue to suffer the most, and for which there's still uncertainty associated. I think as we get in the second half of the year, much of that uncertainty is going to fall by the wayside, and there's going to be a lot of opportunity there. I mean, there's a lot of opportunity now if you're willing to hold on and take a bet that firms aren't going to go bankrupt, because there still is that risk. You've got to carry that. Firms have got to be around. Firms that are around now have got to be around in 6 months to capitalize on that, and there's uncertainty there. But it really, when you look at second half of 2021 and 2022, I think the sectors that hurt the most, still are hurting the most, are those that are going to, take the charge on the recovery and perform extremely differently than what we experienced over the last year.
And I think that helps to answer Sabrina's question here, because she's asking if there's do you have concerns that people, maybe they're not going to spend their savings as expected. So there's obviously been this buildup in savings for those of us who are lucky enough to be employed. And you talked about the K-shaped piece. Some of those necessarily would probably go into savings, like longer term, right? You're not going to necessarily spend that. But I guess what gives you confidence that we're all going to kind of return to normal, whether it's 12 months from now, 24 months from now?
Yeah, I mean, so there's a number of things that we can look at, and one of the things that we look at internally is, so we obviously have, as a large bank, we have credit cards and debit cards, so we track those transactions on a daily basis, and it's been very clear, so far this year, that those transactions, those sales have been stronger than what we'd anticipated. And that's actually accelerated in the last 3 weeks or so. So if it's worth anything, this idea that, even with current restrictions and inability to do a whole bunch of stuff, households are finding a way to spend on what it is that they can. And you're seeing this, you're seeing this in bigger ticket items too, right? Like buying boats, RVs, expensive cars, trucks, high-tech equipment. Basically anything that people get their hands on, bikes, skis, like skidoos, four-wheelers, any kind of good that is, kind of purely recreational, that's pretty expensive. Like it's very difficult to get those right now. And that, to our mind is another kind of signal that people are just dying to spend money on stuff that makes them feel good. And then, you can also look at things like, booking on cruises, right? So Carnival Cruises, this is about a month ago, they had sold more, spaces in 2022 than they had of all already than they did for all of 2019. Again, so, I think it's this kind of thing that you just open things up and people are going to go out and they're going to buy stuff that they've been wanting to buy or do things that they wanted to do for a long time. It's human nature, and we're the evidence that we have suggests that that's going to happen. Whether it happens to the extent that we do, we'll see. But it would be surprising if that wasn't the case.
And then I guess it's interesting, right? So you've had the shock, then there's going to be the reopening of the economy. So if it plays out what you've talked about, but if we compare it to pre-COVID, and this question here from Frank is saying, our standard of living here in Canada stagnating relative to the U.S. And I guess maybe more broadly, like secularly, what has changed from pre-COVID to post-COVID? Is there are there things that have changed and are going to change things forever, or are we going to get back to more of those levels that we saw prior to the outbreak?
So if we it depends what governments do. We're not on track right now to, end up with stronger potential output growth than we had pre-COVID, right? As I said, business investment's likely to be weaker in Canada than in the US. The US is launching this massive infrastructure program, which if it works, if it's successful, is going to raise their long-term growth rates. We haven't really announced anything along those lines, although the government would say, well, we've been doing infrastructure for a long time. And the government's thinking here of doing, national child care, which would, I think, meaningfully impact longer-term growth potential. But apart from that, it's difficult to see anything here that fundamentally alters a trajectory. In fact, when you compare, say, Canada to US in terms of the profile of GDP in our forecast now, for instance, relative to, say, our January 2020 forecast, we never go back above where we were in January of last year. So for 2023, we're going to be below where we thought we were going to be. So there's a permanent loss of output. In the US, with the Biden plan, like, they're going back above where they used to be, right? So keep the trend where it was, and they're beating that. So they're doing things in a different way. Now, mind you, they're doing a whole lot more than they should, and that comes with risks. But so far, if Biden goes forward with his infrastructure plan, they're more likely to come out of this with a comparative advantage relative to us in terms of enhanced longer-term growth potential, which was already stronger in the US than it was here.
And then, well, we'll take one last question. It's 12:58, and this has been great, Jean-François. You're really covering a lot of questions here. So the U.S. 10-year, obviously, the yield has come up quite a bit over the last few months. This question's coming in around the taper tantrum in 2013, comparisons being drawn, and you just talked about all this stimulus, right? I remember like a decade ago, the word austerity started to come out, right? It's like, no one's talking about austerity yet here by any means, right? But they're just talking about, like, it seems like it's different this time. This isn't a taper tantrum per se. What's your perspective on, I guess, past episodes of yields rising in this manner versus now?
Yeah, I mean, clearly markets are responding to the bear economic environment. There's no question about that. So the taper tantrum, in some sense, if you want to call it what we've seen over the last few weeks, an element of that is, I think it's, to the extent that it's a concern, it's more of a concern for vulnerable emerging markets than it is for obviously the US or Canada, where rates are moving in line with what economic fundamentals suggest they should be doing. Perhaps a little bit more rapidly, but that's how markets work, right? They overshoot. Like they're not going to take their time bringing an asset price to where it should be if they think that asset price should be where it is. So you get a bit more rapid movement. Where it's a challenge, though, is what it means for currencies, for like the Turkeys and the Russias and the Brazils of the world, who have over the last few weeks had a harder time as a result of the yield differential, which is moving in advanced economies, well, America's and ours, I guess, in our favor, given the fact that our rates are substantially positive now, and they're better than they are in Europe. So it's not something that I find particularly worrisome. And in fact, what you're seeing, and you saw the ECB do a little bit of this because they're a little bit worried. I mean, I didn't talk about Europe, but Europe is going to go less rapidly than we are. They're having a harder time with the virus, and they can't seem to vaccinate their people, even though they make the vaccines there. But the ECB last week started to push back on the fact that rates were coming up, had been increasing through the yield curve, because that, in their view, is inconsistent with their state of the world. And I say that because it's just a reminder that if we get to a point where rates are moving up too high or too fast in Canada or the US, I mean, both central banks have quantitative easing programs in place, and it's easy for them to say, you know what, a 1.7 Treasury, not right now. That's not where we think it should be, and they can come and take that down. So there are instruments now available to central banks around the world to try and manage the movements in the yield curve if they feel that they're out of line with fundamentals. And so far, in the US and Canada, like, both central banks have not indicated that they think that's the case. If it does be the case, then they can try and do something about it. Whether it works or not, we'll see. But.
Okay, well, thank you very much, Jean-François. So again, Jean-François Perrault, he's a chief economist at Scotiabank. You're very generous with your time. Good interaction today, so thank you kindly for that. I think we'll end it here because it is 1 o'clock. But again, just appreciate everyone attending and joining in on the call, and certainly you, Jean-François. So
Thanks very much. Thanks for inviting me.
Yeah, no problem. Okay. Take care, everyone. Just a reminder, it will be posted on YouTube. So so that's great. So you can share or look back if there's a few of those sections you'd be interested in rewatching. Hope everyone has a great day. Thanks a lot.
Okay, thanks. Bye.